The proper preparation of a statement of cash flows using the indirect method centers around the concept that a company's accounting income, the amount of net income it reports on its income statement, will be different than the actual change that the company had in cash. And to put this concept into some moving numbers, I decided to use this following example for a company called Workout Warriors. And to take this to the very base level, make it as simple as possible, we're going to have Workout Warriors start the period with an unreasonably small amount of items on their books. When they began the period, all they had on their books was $5,000 cash in their bank account and exercise equipment. This equipment had a historical cost of $1,200, and they had already accumulated $175,000 worth of depreciation on this equipment over its life. At the beginning of the period, they do not have any receivables. They do not have any payables, including they don't owe any salaries to the company's assistant trainer, Sven. So all we're starting with is cash and equipment. Let's do some transactions that would happen during the period for this company to see how they affect the company's cash balance in their bank account. On January 1st, Workout Warriors paid $600 cash for rent. So they transferred $600 from their bank account into the hands of their landlord or whoever they're paying rent to. Well, if they started the period with $5,000 cash in their bank account and they're transferring out $600, that means that the balance of their bank account is going to decline down to $4,400. On January 2nd, Workout Warriors is going to receive $5,000 cash for services provided. So they apparently did a ton of training and were paid cash at the time that they performed these services. Well, they had $4,400 in their bank account at this point, but since they were paid in cash, that money was transferred into their bank account, increasing its overall balance up to $9,400. On January 14th, Workout Warriors paid $800 cash to their assistant trainer Sven for his bi-weekly salary. So they're actually paying this employee $800 by taking the money out of their corporate bank account and transferring it into their employee's account, which means that the $9,400 balance that they currently have in their bank account has to decrease by the amount of payment, $800, bringing it down to $8,600. On January 21st, Workout Warriors is going to perform $3,000 worth of services for clients on account, and they billed these clients with a due date for payment a month later on February 21st. And this is where things start to differentiate. Workout Warriors at this point perform the services and they billed the customer for payment in the future, but they didn't actually receive cash at the time. Well, since they performed the services, they met their performance obligations, they would get to record this as service revenue, which would ultimately affect their net income. But since there's no actual payment at the time the services are completed, it does not affect the balance of their bank account, and their bank account at this point would still remain at $8,600. On January 28th, Workout Warriors once again is going to pay Sven his $800 bi-weekly salary, which means they need to reduce the balance of their bank account by $800 because they're actually paying Sven the cash. So it's going to bring it from $8,600 down to $7,800. On January 29th, Workout Warriors is going to sign a $1,000 notes payable with a local bank, and they're going to receive cash in exchange at the time of signing while they're getting the cash, which means they're going to throw it into their bank account, increasing its balance from $7,800 up to $8,800. On January 30th, Workout Warriors will have depreciated their workout equipment by $25. And here's another point of difference. That depreciation expense that they're recording on their equipment is adjusting their net income down, or it's reducing their net income on their income statement, I should say. It is an expense which you can count against your revenues, ultimately lowering your net income, but it's a non-cash expense. They don't have to take $25 out of their bank account to give to somebody because this equipment is losing value. It's just going to affect the book value of the company, but it's not going to actually affect their cash balance of their bank account, which would stay at $8,800. And then on January 31st, Workout Warriors is going to sell that workout equipment they had for $1,100. Well, they're selling it, and that means they're going to be receiving cash in exchange, we'll assume here. So if they had $8,800 in their bank account, they're selling it for $1,100. Their bank account is going to increase to $9,900. And then lastly, at the end of the period, Sven has probably worked some days, but he's not been paid yet. Like, the period is ending in the middle of a pay period. We're going to accrue $225 worth of salaries owed to Sven. And at this point, we would put that salaries payable on our books and record the associated salaries expense. So the expense is on the books in the period January when Sven actually worked, but we haven't paid him yet, which means we would have a $225 salary expense we would record in this instance, which is not going to affect our cash balance, and our bank account would stay at $9,900. So if we began the period with $5,000 in our bank account, and we're ending this period with $9,900 in our bank account, our cash balance, that means that our cash increased by $4,900 during January. Well, let's use this information to prepare an income statement. And the income statement is going to start with service revenue. So what service revenue would Workout Warriors have recorded? Well, they performed services on January 2nd and received $5,000 in cash. They performed services again on January 21st. This time they billed their clients for $3,000, but because we did the job, we met our performance obligations, we still get to record it as revenue. So we record the revenue for both of those as $8,000. For our expenses, we would, starting with salaries expense, have paid Sven his $800 biweekly salary on January 14th. We would have paid Sven his $800 salary on January 28th. And at the end of the period, we would have accrued $225 worth of salaries owed to Sven and recorded the salaries expense for that $225. So in total, we would have a salaries expense on our books of $1,825. For rent expense, we paid $600 rent at the beginning of the period, would be held on our income statement. And for depreciation expense on January 30th, we depreciated our workout equipment by $25. So in total, we would have been recording $2,450 worth of operating expenses, which we would reduce our service revenue of $8,000 by to find operating income of $5,550. And then we would have to report any other non-operating items. In this case, it's going to be any gain that they would have on the sale of that equipment when they sold it on January 31st. Well, gains are the difference between what your books say that equipment is worth at the time you sell it and what you actually receive for it in compensation when you dispose of that asset. So what would our books have shown the value of our equipment at? Well, we started this period, as we can see in the very first information we started with equipment on our books with a historical cost of $1,200. So that would be our historical cost, and if we subtract our accumulated depreciation from that, we get our book value. Well, we started the period with $175 worth of accumulated depreciation. On January 30th, we depreciated that equipment by another $25, bringing its total accumulated depreciation up to $200. And our book value would therefore be $1,000. At the time that we sold this equipment, we would have said the equipment that we are selling has a value of $1,000, but we didn't sell it for $1,000. On January 31st, we sold that workout equipment for $1,100, which is greater than our book value of $1,000, which means we record a gain on the sale of this asset of $100, which we would have to report on our income statement. So our net income would be our operating income adjusted for our others, in this case increased by $100 from the gain we experienced on the sale of that asset, having net income in total for the period of $5,650. And as you can see, that $5,650 of net income that we reported during the period is not the same as our change in cash. So what we would have to do, and what we are going to do, making a statement of cash flows using the indirect method, is to adjust that net income to figure out from it what portion was contributed to cash. Well, let's go through and find the balance of, the change of our balance, I should say, of our accounts for our current liabilities and our current assets. And for receivables over here, we had nothing on our books except for the equipment and cash at the beginning of the period, which means our receivables will have increased by $3,000. And for our current liabilities, all we have is that salaries payable we owe to spend. We started the period with nothing on our books in terms of current liabilities. We have a $225 balance at the end of the period. That's an increase of $225. In here, to reconcile our net income, what we could do is we could start with our net income of $5,650. We could reverse out any gains that we experienced during the period. We just had a gain of 100. We would add back in any non-cash expenses that we recorded that counted against our net income, but which did not change our cash. That would be the $25 depreciation expense we recorded. And then we would make adjustments based on the changes of that current asset and current liability. So if we had an increase in salaries payable, let's add that to net income, because an increase in salaries payable is assumed to, or increase in any current liability is assumed to increase your cash flow. Adjust that up by $225. And then for our AR over here, that had an increase of $3,000. And when you have an increase to a current asset, it decreases your cash flow. So we would adjust our net income down by $3,000, and we would come up with adjusted net income, or cash provided, if you will, by operating activities of $2,800. Well, what happens when we take that $2,800 and add to it the $1,100 that Workout Warriors got from selling this equipment, and the $1,000 that they received from signing that notes payable, which they put into their bank account? Well, $2,800, which is from our operations, added to $1,100 equipment sale, which would go in our investing section, added to the $1,000 from the notes payable, which would go into our financing section, equals $4,900, which is what our change in cash is. So the method is a little awkward, and it's a little conceptual to wrap your head around in the beginning, but it absolutely works. And you can do this with any amount of transactions you want. If you take these following steps as you're going through, you will always be able to adjust your net income to the actual amount of cash that performing your normal operations did, the amount of cash that performing your normal operations provided to your bank account during the period. And we would see that here on our statement of cash flows for Workout Warriors when it was presented properly. So this is the theory behind the indirect method. I don't know who came up with this, who was looking through numbers and decided this actually worked, but God bless that person, because it makes doing this process so much more of a time efficient manner.